Malaysia's household debt is the second highest in Southeast Asia. Should we be worried? Malaysia's household debt is around 80 to 85% of GDP, making it one of the highest in Southeast Asia. Debt headline sounds alarming, but debt levels only matter when we understand what the debt is and how it's structured. In Malaysia, close to 60% of household debt consists of housing loans. These are long tenure loans, secured against property, and subject to income-based lending rules. By contrast, credit cards and personal loans make up a much smaller share of total household borrowing. So the majority of Malaysian household debt is asset-backed and not revolving consumer debt. Now compare this to the region. Thailand's household debt is higher, around 90 to 95% of GDP, and a larger share of that debt sits in unsecured personal loans and auto financing, which historically shows higher default sensitivity during downturns. Singapore's household debt is lower, at around 70 to 75% of GDP, supported by higher household incomes and compulsory savings buffers. Indonesia, Vietnam, and the Philippines report much lower household debt ratios, typically between 35 to 50% of GDP. However, data from the World Bank and regional central banks show that these countries also have lower household credit penetration, lower mortgage lending per capita, and fewer households with access to long-term housing finance. And as a result, the debt to GDP figures are not directly comparable without credit access context. Could also mean that people are not borrowing because they can't. Malaysia's higher ratio reflects broader access to formal banking, higher mortgage usage, and a larger share of home purchases financed through loans. This explains why Malaysia's household debt level is higher than many regional peers, even when consumption patterns are not materially more aggressive. Now, whether or not we should be worried really depends on a few key indicators. We need to look at employment levels, how much income growth we have relative to inflation, household delinquency rates, exposure to unsecured borrowing in lower income groups. As long as debt remains predominantly housing-based and employment remains stable, systemic risk remains contained. So the number is high, but the structure explains why it hasn't translated into a crisis. That's the full story behind Malaysia's household debt statistic.